Imagine you are buying a brand new top-of-the-line smartphone.
Oh, the really expensive ones.
Exactly. You're standing there in the store, and the salesperson tells you that you can get a completely free insurance policy.
Nice.
Right. It covers everything: fire, theft, all the major risks associated with carrying around a tiny, fragile computer in your pocket.
Which you definitely want.
Yeah, and all you have to do to get this coverage is download a specific software app within a set amount of time. Sounds like a fantastic promotional deal for you. But put yourself in the shoes of the insurance company backing that deal.
That's where it gets complicated.
It really does. You are suddenly giving away thousands, maybe millions of policies. And here's the kicker. No one at the company actually sat down to calculate the financial risk of doing this.
Wow.
They're just handing out coverage, bleeding money on every claim, all because of fundamental risk calculation was entirely skipped.
I mean, it sounds like a fast track to financial disaster. And when that company's entirely private, the losses fall squarely on the shareholders, right?
Yeah.
They take the hit for poor management. But when that company is backed by the government, when it's a public entity, those staggering losses are effectively draining public funds.
Taxpayer money.
Exactly. You are no longer just looking at a bad business decision. You're looking at a failure to protect the resources of a nation. It becomes a matter of public interest, not just private equity.
Okay, let's unpack this. Today, we are taking a deep dive into the massive, high-stakes world of auditing public sector undertakings, or PSUs, in India.
It's a massive topic.
It is. Our mission today is to figure out exactly how a nation ensures its public money is being spent wisely, legally, and efficiently. We're talking about everything from sprawling railway networks and colossal steel plants to insurance providers and telecom services.
Yeah.
How do you even begin to keep track of a portfolio that diverse and that large?
Well, it is an undertaking of epic proportions. Just to give you a sense of the scale here, this isn't just about a team of accountants checking a few receipts at the end of the month.
Right, it's not a small business audit.
Not at all. Or reconciling a corporate bank account. We are talking about an entire framework built directly into the constitution of the country. It involves evaluating incredibly complex business operations across vastly different industries. And ultimately, it's about holding the government and its commercial arms accountable to the citizens.
The citizens who fund it.
Exactly. It's the architectural machinery of transparency.
And to really understand how this machinery works on the ground, we have to look at the people navigating the absolute trenches of this system. We're going to follow the journey of a professional named C.A. Smita.
Okay.
She had qualified as a chartered accountant, and then she passed a highly competitive exam to join the Indian Audit and Accounts Service. Her very first posting was in the bustling financial hub of Mumbai.
I mean, Mumbai is the epicenter of corporate activity in India.
The deep end.
Very much so. It makes it an intense, high-pressure training ground for anyone stepping into the world of major commercial audits. The sheer volume and complexity of the transactions there would test any newly minted auditor.
So Smita was thrown right in. She was part of an audit team conducting a test audit of a PSU operating in the insurance sector.
Okay.
Their specific goal here was what's known as a compliance audit. They needed to verify if the company was actually complying with regulatory norms when it was issuing insurance policies. And this is where she uncovers that exact smartphone scenario we talked about at the start.
Wow, the mobile insurance fiasco. What stands out here is how a seemingly harmless promotional gimmick, like a modern marketing synergy where you buy software to get free hardware insurance, it can unravel into a massive compliance failure. Smita's team found this insurance issue. PSU had issued policies to certain companies that sold mobile handsets.
And these handset sellers were using the insurance as a sweetener for their customers.
Exactly.
Smita dug into the paperwork, or, well, rather the complete lack of it. She discovered two glaring problems. First, there was absolutely no actuarial valuation conducted before issuing these policies.
Which is wild.
It is. For those of you who follow corporate finance, you know that an actuarial valuation isn't just a best practice. It's the mathematical bedrock of the entire insurance industry.
It's the whole business model.
Right. It is the sophisticated modeling of risk. You cannot just give away insurance without doing the math to ensure you have the reserves to cover the inevitable claims.
Because if you bypass that modeling, you are flying blind. You have no idea what your exposure is. And the second problem she found really compounds the first one.
The approvals.
Yes. The required approvals from competent authorities were simply not in place. The management bypassed the internal checks and balances designed to catch exactly this kind of reckless underwriting.
They took on unknown risks without permission. And the result was entirely predictable. Smita found that the PSU was taking on heavy losses. They were hemorrhaging money on claim settlements due to this non-compliant underwriting. The public purse basically paid the price for a marketing stunt.
And if we connect this to the broader purpose of a compliance audit, it perfectly illustrates why auditors look beyond the balance sheet. They aren't just looking to see if the math adds up. They are verifying that the rules of engagement were followed. Because when governance rules are ignored, even for a clever-sounding promotion, the structural financial damage to a public entity can be severe and immediate.
Smita's first audit showed what happens when a PSU ignores the rules. But what happens when they follow the rules but are just terribly inefficient at their jobs?
That's a whole different problem.
That brings us to a completely different scenario, the performance audit. Her team was sent to audit a massive, government-owned steel company. This company was right in the middle of a major modernization and expansion of its steel plants.
Now, a performance audit is a completely different methodology from a compliance audit.
How so?
Well, while compliance asks if you followed the legal and internal rules, performance asks if you are actually doing a good job.
Okay.
It evaluates economy, efficiency, and effectiveness. Are the massive capital resources being utilized in a way that actually achieves the strategic goals of the enterprise?
So, in the case of this steel plant, Smita's team found a cascading series of failures. They dug into the operations and highlighted deep deficiencies in project planning, tender finalization, and the actual execution of the projects.
They were just missing the mark everywhere.
Yeah, the most glaring finding was that all the material projects were delayed. Nothing was being completed on time.
And the impact of those delays goes far beyond just extending a construction timeline. During the specific period covered by this audit, the domestic steel industry was actually experiencing significant growth.
It was a boom.
It was. The macroeconomic market conditions were highly favorable for steel producers. But because this PSU was completely bogged down in delayed projects and poor planning, they entirely failed to capitalize on that market growth.
They missed a super cycle.
They did. In a performance audit, you're measuring the cost of lost opportunity. A private company that misses a market boom hurts its shareholders and might see its stock price tank.
Right.
But a public sector steel plant that misses a market boom hurts the national industrial base. It means less revenue for the state, a failure to capture market share, and a massive waste of the capital that was locked up in those stalled modernization efforts.
It really paints a picture of how vital these performance audits are for uncovering chronic inefficiency that might otherwise be hidden behind a wall of bureaucratic excuses.
Absolutely.
Now let's fast forward and follow Smita a few years later. She gets promoted and is posted to a northern state. Her new responsibility is massive. She's compiling a comprehensive report on the overall financial performance of government companies and statutory corporations owned by that state government.
This elevates her role from examining a single steel plant or a single insurance promotion to providing a macro-level view of a state's entire commercial portfolio.
A much wider lens.
Yeah, and a key part of this massive report involved compiling the impacts of what are called supplementary audits. These are audits conducted directly by the Comptroller and Auditor General, the CNAG, over and above the regular financial audits.
She highlights one very specific, very shocking comment from a supplementary audit of a state-owned power generation company. The CNAG had found an improper determination of depreciation in the company's financial statements.
That's a big red flag.
Huge. For anyone familiar with accounting, you know that tweaking the useful life or the salvage value of a massive asset like a power plant isn't just a clerical error. It is a deliberate lever to manipulate the bottom line.
By improperly determining the depreciation, this power generation company overstated its profits by a staggering 20 crore rupees.
That is insane.
That is a massive distortion of financial reality. When a public utility overstates its profits to that degree, it obscures the true operational cost of generating electricity for the state.
It misleads the lawmakers who allocate funding and the regulators who set the power tariffs. Without an independent body coming in to conduct that supplementary audit, that 20 crore rupee illusion would have remained on the books. It was painting a falsely rosy picture of a struggling utility.
Which is exactly why the multi-layered audit system exists. We've seen CA Smita dive into insurance fiascos, stalled steel plants, and phantom power profits. All of these entities she audited fall under the massive umbrella of PSUs. To understand the audit framework, we first have to define the subjects being audited.
So what makes a PSU a PSU?
Public sector undertakings in India are fundamentally defined by their ownership. They are entities owned or controlled by the central government, by any state government, or by a combination of the two. The defining characteristic is state ownership and control.
And their purpose isn't just standard corporate profit maximization. These enterprises have been assigned a key role in the socioeconomic development of the country. They are the engines meant to drive the nation's industrial and economic strategy forward.
Yes, historically, their economic role was foundational to the modern Indian state. They were tasked with supplying the absolute basic inputs required for both industry and agriculture.
The raw materials.
Right, we are talking about the critical infrastructure of an economy. Coal, oil, steel, minerals and metals, cement, chemicals, fertilizers, and heavy equipment.
The heavy lifting of nation building. But it extends beyond raw materials. They also run the massive public utilities that connect the country and keep it running day to day. The Indian railways, the postal and telecom services, electricity generation and supply, and road transport networks.
It is a colossal footprint. Now, it's important to note the evolving context here. While the public sector has historically achieved a truly dominant role in the Indian national economy, the landscape is shifting.
The private sector is getting more involved.
Yes. The private sector is now actively allowed and participating in various sectors that were once solely the domain of PSUs, such as electricity generation and telecom services. But even with this increasing privatization and market liberalization, the public sector's presence remains massive and highly influential.
To manage operations across so many different sectors, the government utilizes three very distinct corporate structures for these PSUs. If you're trying to visualize how the state organizes its commercial arms, you need to understand these three categories.
Category 1 is departmentally managed undertakings.
Okay, what does that look like?
This represents the most direct form of government control. These entities form part and parcel of standard government activities. They do not have a separate corporate identity divorced from the state. They function essentially as extensions of the government ministries themselves.
So the Indian Railways is the classic example of a departmentally managed undertaking. It's a massive operational arm of the government. The same goes for the postal services, the security printing press where currency is minted, and the canteen stores department.
Right, and that departmental control is a stark contrast to how our second category operates. Category 2 consists of government companies. These are structured under corporate law, specifically set up under the Companies Act, 2013, in the current legal landscape. This category also includes what are known as deemed government companies.
So, unlike the railways, these entities actually have a corporate shell, just like a private business. They have a board of directors, they issue shares, but the crucial difference is that the majority of those shares, the controlling interest, is held by the government.
Exactly.
They're meant to operate with the flexibility and agility of a commercial enterprise, but with the state as the primary shareholder.
And finally, we have the third category, statutory corporations. These are unique legal constructs. They aren't just government departments, and they aren't companies registered under a general corporate act.
So where do they come from?
They are brought into existence by specific acts of the legislature. Parliament or a state legislature literally passes a law to birth them.
Think about giants like the Life Insurance Corporation of India, or LIC, and the Unit Trust of India, UTI. When an entity is created by a specific legislative act, that act defines its exact powers, its functions, its management structure, and its intricate relationship with the government. It gives them a very solid, distinct legal mandate tailored to their specific market purpose.
So we have departmentally managed behemoths, government companies operating under standard corporate law, and statutory corporations willed into existence by specific acts of Parliament. We are talking about thousands of entities dealing in trillions of rupees, impacting every sector of the economy.
Which begs the question.
Right. The overarching question becomes, how does anyone manage to oversee all of these varied entities? You cannot have the government auditing itself through internal departments.
The conflict of interest would render the audits meaningless.
Exactly. You need a watchdog with teeth. And more importantly, a watchdog with an impenetrable constitutional shield. In India, that watchdog is the Comptroller and Auditor General of India, the CNAG.
The CNAG is an independent constitutional authority, and that independence means they don't report to a cabinet minister, and they don't take orders from the current political administration. Their existence and their power are baked right into the foundational document of the Republic.
The architects of the Constitution understood that true accountability requires absolute, structural independence. To protect the public purse, the auditor must be immune to political pressure or retaliation. The Constitution goes to great lengths to safeguard this independence, specifically laying out the architecture of this role in Articles 148 through 151.
Let's walk through these articles because they form the blueprint for this entire oversight system. We start with Article 148, which we can think of as the shield. This article dictates that the CNAG is appointed directly by the President of India.
But appointment is only the first step. The real protection lies in the rules for removal. Article 148 prescribes a very rigorous special procedure for the removal of the CNAG. They can only be removed from office on the specific, heavily scrutinized ground of proven misbehavior or incapacity.
So you cannot dismiss the CNAG just because they published a highly critical audit report regarding a flagship government program.
Exactly. Furthermore, their salary and other conditions of service are determined directly by Parliament.
Meaning the entities being audited do not control the auditor's budget or paycheck. Building on that constitutional foundation, we also have the Comptroller and Auditor General's Act of 1971. This act dictates that the CNA holds office for a strict term limit, 6 years, or up to the age of 65 years, whichever comes earlier.
Term limits are a vital governance safeguard. A 6-year term is substantial enough to conduct meaningful, long-term, systemic investigations, but this strict limit ensures regular rotation. It prevents any single individual from accumulating entrenched power over decades.
Makes sense.
And of course, they retain the right to resign at any time by addressing a formal letter to the president.
So Article 148 provides the shield. Article 149 provides the sword. This article outlines the actual sweeping duties and powers of the CNAG. It mandates that they perform duties and exercise powers in relation to the accounts of the Union, the states, and any other authority or body as prescribed by Parliament. It's the constitutional mandate to demand access to the books.
Then we arrive at Article 150, which addresses a highly technical but crucial aspect of auditing standardization. This article states that, on the advice of the CNAG, the President will prescribe the specific form in which the accounts of the Union and the states must be kept.
And for anyone who has ever tried to consolidate financials from different subsidiaries that use different accounting software, you know why standardization is critical.
Oh, it's a nightmare otherwise.
It really is. If every state and every union department kept their financial records in a different format using bespoke accounting principles, auditing them at a national scale would be impossible.
Standardization is the enemy of financial obfuscation. By giving the CNAG the power to dictate the exact form of the accounts, the Constitution ensures that the financial data is presented in a uniform, auditable, and transparent manner. You cannot easily hide a 20 crore rupee depreciation manipulation if you're forced to adhere to a rigidly standardized reporting format designed by the auditors themselves.
Finally, we reach Article 151, which is effectively the megaphone. The CNAG can conduct the most rigorous audits in the world, but if those reports are buried in a bureaucratic vault, it doesn't serve the public interest. Article 151 mandates that the audit reports relating to the accounts of the central or state government must be submitted to the president or the governor of the state.
And the mechanism of accountability doesn't stop there. The president or the governor is legally required to cause those reports to be laid before Parliament or the respective state legislative assemblies.
So it's forced out into the open.
Yes. The executive branch cannot simply suppress a critical audit report. It must be presented directly to the lawmakers, to the elected representatives, where it officially enters the public record.
The constitutional framework is incredibly robust, but the sheer volume of what falls under their jurisdiction is staggering. The scope of the CNAG covers all the union and state government departments and offices. That alone includes massive operational networks like the Indian Railways and the posts and telecommunications infrastructure.
And beyond those government departments, their mandate covers all the public commercial enterprises controlled by the union and state governments, all the government companies and statutory corporations we detailed earlier.
Right.
And their reach extends even further into the quasi-public sphere. They also audit non-commercial autonomous bodies and authorities owned or controlled by the union or the states.
They also have a fascinating catch-all provision. They audit any authority or body that is substantially financed from union or state revenues. So even if an organization isn't officially labeled a government department or a PSU, if it is running primarily on taxpayer money, the CNAG has the constitutional authority to follow that money and audit its utilization.
Which means the CNAG is tasked with overseeing virtually every rupee that moves through the public and quasi-public sphere. But this introduces an immense logistical and practical
Or
challenge.
so.
Given the vastness of the scope across a massive, rapidly developing country, how does the CNAG actually execute audits on all of those Category 2 and Category 3 PSUs? We are talking about hundreds of complex government companies and statutory corporations engage in highly technical commercial activities.
Well, the mechanics of a commercial audit involve a fascinating hybrid approach. The CNAG does not rely solely on a massive internal army of government auditors. There is a special arrangement specifically for the audit of government companies, which are defined by the 51% rule.
The 51% rule.
Yes, companies where the equity participation by the government is 51% or more. When the government holds that controlling majority, this hybrid audit arrangement kicks in.
The primary auditors who actually go in and do the ground-level financial auditing for these government companies are not government employees. They are private firms of chartered accountants.
Now, at first glance, outsourcing the audit of public companies to private sector accounting firms might seem like it defeats the purpose of having a constitutional watchdog.
Yeah.
It sounds like they are outsourcing accountability.
It might look like a loophole, but the CNAG maintains incredibly tight control over the process. The CNG directly appoints these private chartered accountant firms. More importantly, the CNAG gives these private auditors strict, specific directions on the exact manner in which the audit must be conducted.
So they're playing by the CNAG's rules.
Exactly. The private firms are executing the heavy lifting of the audit, but they are doing it entirely according to the CNAG's mandated playbook.
And the oversight doesn't end when the private firm finishes their fieldwork and submits the report. The CNAG is legally empowered to review and formally comment upon the audit reports submitted by these private auditors. If the private firm missed a glaring compliance issue or failed to dig deep enough into a dubious transaction, the CNAG will call it out and amend the findings.
The CNAG always retains ultimate authority. If they feel it is necessary to dig deeper, they have the right to issue an order to conduct a supplementary audit themselves, using their own personnel, over and above what the private firm completed.
They can just step in.
Yeah, they also have the authority to conduct test audits whenever they deem fit. This hybrid system cleverly utilizes the massive manpower and specialized corporate financial expertise of the private sector, while fiercely maintaining the rigorous oversight and constitutional authority of the public watchdog.
Auditing the pure financials is only one part of the equation, though. What about evaluating the overall performance and operational efficiency of these complex enterprises? As we saw with C.A. Smita, auditing the delayed modernization of a steel plant's blast furnaces requires very different expertise than auditing the risk models of an insurance firm.
That's where it gets really interesting. The Indian Audit and Accounts Department addresses this need for specialized technical knowledge by utilizing a very unique structural feature, audit boards.
Audit boards.
Yes. These boards are specifically constituted for conducting comprehensive audit appraisals of the working of public sector enterprises engaged in diverse, highly technical sectors of the economy.
These audit boards are a brilliant solution to the problem of technical complexity. The CNAG knows its people are exceptional financial auditors, but they aren't necessarily metallurgists, aeronautical engineers, or actuaries. So these audit boards associate themselves with external industry experts in disciplines relevant to the specific enterprise being appraised.
For instance, if you are conducting a performance audit on a massive hydroelectric dam project, you bring in structural and civil engineering experts. If you are auditing a state-owned pharmaceutical manufacturer, you bring in chemical engineers and medical supply chain experts.
That makes total sense.
It ensures that the performance audit is evaluating the enterprise against actual, rigorous industry standards, not just bureaucratic, paper-pushing checklists.
There is also a highly collaborative due process step built into this appraisal mechanism. Before the audit board finalizes its highly consequential report, they sit down and discuss their findings and their conclusions with the management of the enterprise they are auditing. They also involve the controlling ministries and departments of the government in these discussions.
This step is critical for fairness, accuracy, and operational context. The board wants to ascertain the viewpoints of the management before the report is codified and sent to Parliament. Perhaps there is a valid, highly technical, operational reason why a project was delayed that the financial auditors didn't fully grasp.
Right. There could be a perfectly reasonable explanation.
Exactly. Or perhaps the management simply needs to be confronted with the data so they can prepare their strategic response. It ensures the final report is robust, fact-checked, and contextually grounded in the reality of running a major industrial operation.
Once that collaborative process is complete, the results of these comprehensive appraisals are incorporated by the Controller and Auditor General into their final official reports. It is worth noting a specific legal detail about these audit boards. They have no separate legal entity.
That's true. They are not permanent statutory bodies in their own right. They are effectively specialized ad hoc task forces. They operate entirely under the direct supervision and control of the Controller and Auditor General.
The CNAG is always the boss.
The CNAG delegates the deep investigative work to the board and the industry experts, but the final authority and the ultimate responsibility for the report's conclusions always rests squarely with the CNAG.
Let's track the journey of accountability so far. We have the CDG framework authorizing the audits. We have private CAs doing the financial groundwork and specialized audit boards doing the comprehensive performance appraisals. As a result of this massive machinery operating year-round, the CNAG issues a mountain of audit reports every single year. Hundreds of highly detailed, complex, technically dense documents. Where do all these reports actually go to create change?
Under Article 151, they go to the President or the Governor, who then fulfills their constitutional duty by laying them before Parliament or the state legislative assemblies. But this introduces a massive logistical bottleneck in the democratic process.
The problem of sheer volume and technical density. The scrutiny of all these annual accounts and the audit reports by the Parliament as a whole would be a completely arduous, practically impossible task. Imagine all the members of Parliament trying to collectively read and debate the technical depreciation manipulation of a state power company, alongside the metallurgical project delays of a steel plant, alongside the actuarial failures of an insurance promotion.
It's functionally impossible. These reports are incredibly diverse and highly specialized. Furthermore, if Parliament attempted to debate every single audit finding on the floor of the House, it would impose excessive demands on their limited legislative time.
They wouldn't have time for anything else.
Right. Parliament has to debate national security, foreign policy, major legislative overhauls, and national budgets. They cannot spend all their time acting as a massive 500-person accounting review board.
To process this vital data without grinding the legislative process to a halt, the system relies on specialized parliamentary committees. The Parliament and the state legislatures have constituted specific, focused committees to which all these audit reports and annual accounts are automatically referred for deep scrutiny.
This is the crucial juncture where audit findings are actually translated into democratic accountability. There are three main committees that handle this monumental task: the Public Accounts Committee, the Estimates Committee, and the Committee on Public Undertakings.
Let's examine the specific mission of each one, starting with the Public Accounts Committee, or the PAPC.
The POT is the classic, formidable financial watchdog committee within Parliament. Its duty is to satisfy itself on three main fronts regarding government spending.
First, they must ensure that the monies were dispersed legally on the specific service or purpose to which they were applied. If Parliament authorized funds to build a highway, the PUTE verifies that the money actually went towards building a highway and wasn't illegally diverted to another program.
Second, the PUTE must ensure that the expenditure incurred was actually authorized by competent authority. You cannot spend public money without the explicit legal authority to do so. And third, they deeply examine the process of reappropriation.
Reappropriation is the distribution of funds. It's when a department realizes they have a surplus in one budget allocation, and they want to move it to another allocation where they are running a deficit.
It is a common practice in any large, complex organization. But in government, you cannot just shuffle money around internally without oversight. There are strict rules governing how, when, and by whom funds can be reappropriated. The PAC's job is to ensure that whenever money was redistributed, it was done in strict accordance with the rules and provisions laid down by Parliament.
The PAC also has an extra duty. They are responsible for examining the statement of accounts of autonomous and semi-autonomous bodies, specifically those where the audit is conducted by the CNAG under the directions of the President or by a specific statute of Parliament. So they are keeping a close eye on both the core government departments and these specific autonomous entities.
And while the PAC focuses heavily on legal compliance and budget adherence, basically following the money, the Estimates Committee has a different mandate. The Estimates Committee is looking at efficiency and administrative policy. Their mission is to examine the estimates with a view to finding economies, improvements in organization, efficiency, or broader administrative reform.
They are tasked with suggesting alternative policies to achieve the same objectives more efficiently. They examine whether the money is well laid out within the limits of the policy. Are the taxpayers getting optimal value for the capital being deployed? They also suggest the specific form in which the financial estimates should be presented to Parliament to ensure maximum clarity for the lawmakers.
But the Estimates Committee operates under a very crucial limitation regarding their power. The committee cannot comment upon a policy that has already been debated and approved by Parliament.
They can't overrule the legislature.
Exactly. They're not there to second-guess the political or strategic decisions of the legislature.
They can attack the politics of the policy, but they can't attack the execution. If there is clear evidence that a particular approved policy is simply not leading to the desired results, or is actively leading to a massive waste of public funds due to poor administration, then it becomes the duty of the Estimates Committee to bring that administrative failure to the notice of the House.
This brings us to the third committee, which is the apex predator of oversight for the specific entities we have been discussing today, the Committee on Public Undertakings, or COPU.
The COPU.
Yes. As the name suggests, this committee is dedicated entirely to the commercial arms of the state.
COPU exercises the exact same rigorous financial control over the public sector undertakings as the Pavey case exercises over standard government departments. They are the specialized, focused oversight body for the state's commercial portfolio.
Their duties are extensive and highly consequential. First, they independently examine the reports and accounts of the public undertakings themselves. Second, and crucially, they examine the reports of the CNA on those public undertakings.
So when CA Smitta's report on the steel plant delays or the power company's depreciation manipulation is finalized by the CNA, it lands directly on the desks of COPU.
Yes, and their mandate goes far beyond just checking the financial math. COPU is tasked with examining the autonomy and the operational efficiency of these public undertakings. They have to evaluate whether these massive entities are actually being managed in accordance with sound business principles and prudent commercial practices.
Are they acting like functional competitive businesses, or are they bogged down in bureaucracy and poor management?
That's the core question. COPU conducts a truly comprehensive appraisal or evaluation of the undertaking's performance. It involves a thorough, deep-dive examination, evaluating the overarching policies, the specific operational programs, and the overall financial working of the undertaking. Furthermore, they are vested with any other functions of the PS and Estimates Committee that relate specifically to PSUs as allotted by the Speaker of the House.
This intricate, constitutionally protected pipeline is fascinating. CNAG auditors like Smitta uncover the compliance and performance failures. The audit boards bring in the technical experts to appraise the massive industrial projects. The final reports are routed through the President to Parliament. Parliament refers them to COPU, or the PPIC. But the ultimate test of this entire system is whether these committees effectively translate those highly critical audit findings into actual, sweeping policy changes and managerial accountability.
The machinery relies entirely on the diligence, political will, and rigorous follow-up of these specific groups of lawmakers. If COPU reads a report about a 20 crore rupee depreciation manipulation and simply files it away without demanding answers from the Utilities Board of Directors, the audit hasn't achieved accountability.
It's just a piece of paper.
Exactly. The system requires the parliamentary committees to call the management to answer, to demand systemic operational changes, and to hold the relevant ministries responsible for fixing the failures uncovered by the CNA.
The audit report is the diagnosis. The parliamentary committee must be the surgeon that actually operates to fix the institutional problem. Without the active, rigorous follow-up by the PANAC, the Estimates Committee, and COPU, the entire constitutional framework of the CNAG, while brilliant in its design, would simply be generating highly accurate paper.
We have covered a massive amount of ground today. We started in the commercial trenches of Mumbai, with C.A. Smitta uncovering a catastrophic lack of actuarial risk calculation in a mobile phone insurance promotion,
Demonstrating how quickly public funds can drain when compliance is bypassed.
We saw how performance audits reveal the hidden systemic costs of delayed steel plant projects, highlighting the massive opportunity costs when a public entity misses a favorable market supercycle.
And we saw how supplementary audits expose deliberate accounting manipulations, like the 20 crore rupee illusion in a power company's stated profits.
We defined the giants themselves. The departmentally managed undertakings like the railways, the government companies operating under corporate law, and the statutory corporations birthed by specific legislation. We discussed their vital, evolving socioeconomic role in supplying everything from fundamental industrial inputs like coal and steel to massive telecommunications networks.
We unpack the incredible constitutional armor that protects the Comptroller and Auditor General, ensuring their independence through the strict removal procedures of Article 148 and the reporting mandates of Article 151. We explored the clever hybrid mechanics of utilizing private CA firms under the strict supervision and rulemaking authority of the CNAG and the collaborative, highly technical expertise of the audit boards.
And finally, we followed the paper trail all the way to the halls of Parliament, breaking down how specialized oversight bodies like the PACIC, the Estimates Committee, and COPU act as the crucial final filter. They're the mechanisms that turn massive volumes of technical audit data into actionable democratic oversight.
The ultimate takeaway here is that public sector auditing is not just a back-office accounting function. It is the invisible constitutional machinery that keeps the economy's most vital sectors honest, efficient, and accountable to the public that ultimately funds and owns them.
It is a monumental, continuously evolving task. As the economy modernizes, the complexity of what needs to be audited only grows exponentially.
Which brings me to a final thought for you, the listener, to mull over. We have seen how robust this constitutional and parliamentary system is. But remember that the CNAG framework and the structure of these parliamentary committees were designed decades ago in an era of paper ledgers and analog-heavy industry. We are now entering an era where PSUs might soon be dealing with cutting-edge technologies, deploying artificial intelligence for public services, or perhaps even engaging with digital currencies and blockchain-based smart contracts. As the nature of public sector business becomes radically more complex, digital, and automated, how might the traditional deeply bureaucratic methods of the Estimates Committee or the audit boards need to dramatically evolve? How does a framework built for auditing physical steel plants and railway networks upgrade itself to catch the next 20 crore rupee mistake when that mistake isn't an accounting error on a spreadsheet, but is buried deep inside an algorithmic black box?
It is the defining question that the constitutional auditors of tomorrow are going to have to answer very soon to maintain that critical chain of accountability.
Thank you for joining us on this deep dive into the fascinating high-stakes world of public sector auditing. Keep questioning, keep learning, and we will see you next time.